Hi, everyone. This is Michael Bengiat with Lifetime Investor. Just wanted to say Happy New Year. And this is going to be our last video of the year for 2022. So let's go ahead and just get started. Here's our disclaimer. So we're going to go, as usual, we're going to go into the current market environment. We don't have any stocks in the portfolio, so nothing to review there. We'll go through the few stocks on our watch and ready list. And then I also want to go over, let me add this here while I'm talking. Whoops. So lessons from 2022. That we see we can learn from a lot of the mistakes we find that investors have made this year and try to fix them for next year. Okay, so let's get going. First, I want to talk about our portfolio. So in 2022, we went down 5.12% in our main growth portfolio. And then we are actually up on our long-term outperformer portfolio. So how did that happen? How did we end up here versus the NASDAQ went down 33%? So, well, first of all, let's come back to the growth. While we're never happy to have a loss, in a bear market, having just a 5% loss is actually really good. I don't know if almost all the best traders have had single-digit losses. And what we're always trying to avoid is to dig ourselves in a big hole and having double-digit, especially 10, 20, 30%. That becomes a big problem, showing that you really didn't manage risk very well. So the fact that we're down 5% is not bad. Most of it was we just kept taking smaller and smaller shots, never getting very largely invested because our system never gave us that green light. It was basically yellow or orange lights and red the whole year. So, and of course, it was just a lot of little small losses adding up. But the important thing is, though, once the market turns positive and we actually have an extended period, it doesn't matter if it's a bull market that doesn't last for a long time, or just if it is that we finally bottomed out and off we go again. To get back that 5% is very doable very quickly. So the whole point is, we don't want a big drawdown. And you can see here, just from when we started this service in the mid, I think it was August of 2020. So already kind of missing the beginning of that big blast off. But overall, since we started, we're up 31.32%, which is really pretty good. So we only lost a little of that during the 2022. So once we get a good, in this, 2021 was a difficult year also. So the whole idea is if you make money, you don't want to give it all back. So we've been very good about keeping that on a short leash here. So that's good. So if you're down anywhere around here too, very good. You did things right. Not a lot of people ended up in the green. Now, for the long-term performer portfolio, we are in the green because we had very few stock trades. They just weren't there. And that's a big lesson in itself, is that you don't trade if things are not in your favor. I mean, we just sat there and watched, and the long-term outperformers are considered to be long-term trades. You're position trading. You're not swing trading these. And that has not worked. You can actually see, if I go here to our daily, this is actually from our email we send out, but you can see the strategy has just been very short-term swing trading. And the traders that have done the best this year, that's what they did. They sold into every breakout. That most of them lasted sometimes one day, maybe you got a week, but very, very few stocks actually ended up going up and continued up. It was a lot of just little pops, the pop and drop. We talked about the pump and dump. That's been the thing. So that system of buying long-term outperformers, this never worked. So we had very few trades, and we were positive just a little bit overall. So in the end, in a bear market for the indexes and many, many stocks down 50, 60, 70%, we ended up positive. So that's actually pretty good. So there's a lesson. You don't trade if there's just nothing to trade. And, we're not trading for excitement. We're trading to make money here. And that's something, if that's something you find yourself doing, you have to sort of take a look at yourself closely and say, well, maybe I'll get my excitement somewhere else, by jet skiing or doing some other activity, and not, using your capital, your hard-earned money to fulfill that need. Okay, so just we'll get to the lessons in a little bit. I just want to first go into just we haven't had much of a change all year. Lean stocks did pretty good on Friday, but overall we're just not getting the action we want to see. So nothing's really changed, and unfortunately, so. But I want to say that this is really the key thing to be watching. I mean, this will tell you what the best thing to do is. And we have very little exposure. If you have anything, just take your money and run. In fact, it's just been very few stocks, as I mentioned, that have actually continued up. So that's where we are. We want to see all that change, but we're just not seeing that. Let's go. Actually, let me go ahead. I'm going to go ahead and just talk about the lessons. And if you're with our market trend advisory, I kind of covered these in that video, but I'll go over them here too. So the first thing is that all stocks are risky. There's this belief that you're gonna and people see, oh, well, this guy bought UPS in 1970 when he was working there or whatever, and he held it all the way till and he ended with $17 million. You see these stories every so often, but it's like the same story of he bought one lottery ticket and won the lottery and won $75 million. Sure, it's going to happen to someone, but it's just a complete crapshoot that's going to happen to you. That's just luck, and some people are lucky, but you're going to bet on that. But going back to this, so when you hear those stories, it doesn't matter because you're probably not going to be that person. They're all risky. They will all go down. I mean, a year ago, no one, if I had said, hey, Amazon and Google and Apple and Tesla, they're all going to be down this year. They'd be like, no way. They're just going to, you buy the dips. That's what you do. You buy the dips and they always come back. Well, that's not the case. They don't come back. And Tesla dropped 40% in December alone. It's down close to, I think, 67 or 69%. So that's just, that's what happens. And you can go back in history. There's the Nifty 50 in the 50s and 60s. There were stocks like Kodak and I think General Mills or General Motors or something. And they all said, oh, you can't go wrong with these. These are the new technology stocks and the new this and new that. Well, a lot of them went bankrupt. And they all ended up down a huge amount. So all stocks are risky, and the lesson is that they all must be sold when the selling signals start to develop. So the next one we're talking about is the bottom fishing. Actually, I'm going to pause this for a second. I need to bring in some other charts from my market trend advisor, so I'll be back in 1 second. Okay, I had to copy in some charts. So we're talking about the bottom fishing here. So the poster child for bottom fishing is Kathy Wood of the ARK Fund. So I wanted to show you the chart. So in 2020, she had a massive run that really brought a lot of money in. You can see here as the volume just started getting higher and higher. And unfortunately, because of the way she does things, it has given all of it back and more, which is what happens in bear markets. And why has this happened? Because she has absolutely no risk control or any sense of protecting the account. And so she has many, I think almost all of the stocks in her portfolio. Now she's buying these high-flying disruptors. That's what and it sounds great. They're in genomics and automation and robotics and Tesla's a big name, DocuSign, I think is another big, but they've all cratered, in some cases 90%, and she has no risk control. So she's buying these stocks over and over on every dip. But you can see when the stock goes into a downtrend, or in this case a fund, I mean, where's the bottom? This looked like the bottom, this looked like the bottom here. Oh yeah, and we start seeing these big up days here where the stock these are weekly chart. So early in the week it came down low and then it rallied all the way back up. There's the bottom. So everyone's like piling back in. And then, of course, that wasn't the bottom. And then look at this week, huge move, a giant move all the way up. That wasn't the bottom. Then it had a huge decline after that. And then the buyers all piled back in. And that wasn't the bottom. So she's buying these stocks. In fact, on yesterday, she was piling back in and she bought more Tesla and she bought more think it was DocuSign, or I forget a few names. She's just buying, and it's like it. I think the part of the problem is not her money. And that's the sad thing about fund managers. They obviously want to keep their jobs, but she's in charge of the ARK funds, so I don't know if she can actually lose her job. But people just keep believing in her, and they're just letting. And she's just saying, "Well, we have a 5 year." Probably at one point she said we have a 1 year time frame. Now she's saying you forget about the dips. Well, it's off 81% from its highs. You're not going to forget about the dips because you keep saying, "Oh, we have a 5 year time. These are all going to rebound, and this is going to be a huge winner." Well, the problem is that it's just talk. It's not a huge winner. It was here, but we're down 81% from the all-time high, 63% in 2021. This is just not how you do things. You have to have. You can't bottom fish, which is what she's doing. Where's the bottom? No one knows where the bottom is. The ARK fund, this could go to 5. It could go to 2. In fact, what happens eventually if investors just realize, hey, you know what, we've been stupid, and they start liquidating and all the redemptions come in, then she's forced to sell all these stocks down here. And at that point, the funds sometimes just close, and then you're out. You've just lost everything. So very, very, very difficult. So this is one thing. No one knows where the bottom is. They all say you're catching falling knives. You're just going to get cut up, and it will lead to ruin. And for many people in this, maybe they got their money back. But if you have been an investor in the last, let's see, how many years? This was 19, at least in 2 years, most people came in here. You can see there was really not much trading going on. All the interest came in 2020, and now they're all losers at this point. And some of them who bought up here, we'll look at the volume, really had a lot of volume. Now, if you were in this fund too, there's a lot of sell signals that were going on up here. So there's no reason to be hanging on there unless you just weren't paying attention. The other one I want to talk about here is, we talked about the belief in the FANG stocks. They can't go down. They all go down. I mean, Amazon at one point went down 90%. Many of these stocks that you think can't go down went down 50%. A lot of them went down to 90% and went bankrupt. So that's the thing. They all have to be sold. It doesn't matter if it's Facebook. Well, now this is probably the MANG stocks, I think. If it's Apple, Netflix, Google, they're just, and then Tesla, that's the big one today. They can't go down. Well, it's down. In fact, I'll show you in a little bit about that. Comes with not knowing or heeding the sell signals. And you can't, there really are no stocks that you can buy and hold for like your lifetime or a generation. Yeah, maybe you can buy, Pepsi or Coke. It may not ever go bankrupt, but it can go down 50, 60%. And if you look at a chart, you will see it. Even Google, they have these moats, you can never go down, no one's going to replace it. Well, I've started to read things about AIs coming into search, and it's starting to do things that Google could never do. And they may not be able to catch up. And you could see that suddenly Google starts losing a lot of market share and advertising dollars, and that was it. And I'd say the other thing about these big FANG stocks is that once they top out, they're just so big these days that they're probably not going to be the big leaders they were. They're too big. There's too many people to get things done. They can't be nimble. There's going to be new big winners that are coming out, emerging now that we're all trying to find. But it's not going to be the big FANGs. They're too big, and they can't grow at those rapid rates that they did when they were small companies. And so there's nothing wrong with them. They might be just a part of a portfolio that is stable, just generates lots of cash, but you may not see those big moves again. So they can go down and they can stay down. And there's lots of examples in history of these big, too big to fail companies, like Cisco, great example, never has come back to its all-time high in 2000. And this was the backbone of the internet. They were making all the routers and the gear. And it felt, look at the growth of the internet. This could never go down. Well, it did, and it's never come back. I can go on forever on this. We'll move on to the next one. Not heeding or knowing the sell signals. This is probably the biggest one. And I want to just give you a couple examples from the poster child, Tesla, because everyone just thought, this has been the one that everyone's just, the big mover. But of course, we're down huge on the stock this year. So I want to point out just some of the sell signals that we're developing along the way, especially towards its final run. So we had a bunch of climax runs, and these are sell signals. If you don't know them, I'll talk a little bit about how you can learn them. But this was just an example. This is in August of 2020. We went a really quick from 273 to 500. We're getting close to a by 80-something% move in just a couple weeks. Then we had the big correction, but it tightened up again and broke out again. Then here we went on a final, the second climax run, and we got to this part here in green. We had 11 days up in a row, 100% gain in 7 weeks. That is a sell signal. The stock was 130% above its 200-day moving average. That's this black line. Another sell signal. We were getting gaps, exhaustion gaps, biggest moves like here. In the whole move, percentage gains and the more sell signals. So this was kind of giving you, if you're still part of this, or if you had bought this, sold into this, bought it again, sold into this. In most cases, this was the end. Most stocks will give you one climax run, and that's pretty much the end of the move. This one went 1, 2, and then it went on a third one. And this was the second one over here. That's what this says, previous climax run. Then it had a real big drop. This is why, even this one from 900 to 539, we were approaching 40% move or so down. And then it kind of started to tighten up again. And then we finally had a really nice buy signal right here, right before it went in this final blow off top. Again, we have gaps, a gap here, we gapped here, we gapped up in here with make these island tops, another sell signal. We had the biggest one-day moves. We had the biggest volume. There's just, we're talking 4 or 5 sell signals all going on here. We weren't as extended above the 200-day, but it was kind of giving you that signs. All in all, another sell signal. And this was the top, and we're down now 70% from here. So the signs are all there if you know what to look for. So what I want to say here too, about 6 months ago or so, I put together a Selling Stocks Mastery course. And I wanted to offer you guys, if you're interested, there's $100 savings. It's normally $197. You can get it for $97 using this coupon code 2023 New Year. It's got 5 hours of videos. There's 29 videos. Really, I'll teach you everything about all the signs, all the sell signals, whether you're doing position trading or if you're just swing trading, trying to get out at times. And also we go into how to use stops. And that's probably the last thing on here, not having risk control and not using stops. If you just think about, probably most people, they end up taking bigger losses than they should. And there's a saying, the first loss is the best loss. And one of the reasons, and if you do nothing else about learning about stops, if you just say, I will no longer ever take a loss larger than 7 or 8%, you're going to be way ahead. Because 7 or 8% is to get back that, say you have a stock, you buy it, you lose 7%. The next trade only has to go up about 8%, a little less, to get your money back. And it's totally doable because you'll see 10% moves in stocks. All stocks will make a move like that. If you have a 20% move down, now you need, I forget the numbers offhand, it's like a 30-something% move. If you have a 50% move down, you need a 100% move on the next trade to make your money back. The numbers don't work for you. So you want to keep them small. And the other reason too is that, just you can take a number of losses in a row and then not really hurt your account. And of course, if you're paying attention, if you're getting a lot of losses in a row, it's telling you something. The market's poor, or you're not buying correctly, or other things means you need to back off, trade smaller and smaller. And eventually, as you see, like in our stock picks, we get to the point we're trading tiny positions, or we just don't trade at all because we're not getting the feedback that our trades are working. So these 5 here, all stocks are risky, the bottom fishing, all stocks will go down, and knowing the sell signals, and then using stops to protect yourself once you're in. And then actually, once you have a profitable position, you can use your stops to help lock in gains and do some other things and protect yourself from giving it all back. So those are the lessons. I hope you are, continue to learn. Everyone's learning. We all make mistakes. Things happen in the market out of our control. All we can do is just control what we do. Especially, we can only control how and when we buy and when we sell. We don't have control what the stocks can do after that, but we do have control over how much we are willing to lose if the stock goes down from where we buy it. Okay, so let me go ahead and just go quickly through some of the stocks on our list. Let's go to the first one. Oh, let me reset this. Okay, the first one is Olink. There's just not a lot. This is on our growth stock ready list. Let's get rid of that. So you can see here we have a base. We're kind of a little bit of a handle of a base here. We did have our buy zone is right around there. It's at 24.82, and the stock just keeps. Actually, I'm a little low there. Sorry. Unfortunately, this program, you can't, once you draw a line, you can't move it. But we're right about here. It's like we're breaking above this little resistance area, and we're just below it now. But the stock is tightened up, a nice low volume. You can see we're getting this little pattern is just tightening up. We try to break out, and it's just the market, of course, is holding it back. But overall, it's acting really pretty well. Now, this is a biotech, so there's always a little bit more risk in these stocks. It's a little bit low on the trading volume, but it's acting really pretty well. So we've got that on the ready list. But in this market, we're not buying it. It's just we're not seeing any feedback that the trades are working. So anyway, but that's on there. And that's something you do want to track. You'll start seeing that if we get a lot of stocks start moving onto the watch list, it's a good sign. If they move into the ready list, that's a good sign. If there's very few things showing up, that's another really good sign that the market is not very good. So here's another one, LSI Industries. This one is really acting very, very well. Look at the S&P. It's coming down. This was making new lows in the market, and this was kind of just holding up, then broke out. As soon as the market started to have a little bit of uptrend, this broke out. Now we're at new highs, and our buy is right above here. We closed just below it, so we're back in the watch list. But we're at a little bit of high volume. This is the highest volume since the base. And a little bit of a warning sign there. We don't want to see high volume, especially when the stock's coming in. We want high volume on the way out, but which we did. Here we had a little bit. This is 50-day volume, this red line, but then we had even higher volume coming back in. That's not a confirmation of a good sign. So you see if these start piling up, these more down days in a row, the stock's just not working. And this has just been the theme. You get these try to break out and the pop and drop or pump and dump. The charts are filled with these things. The breakouts just aren't working. So next one is Cardinal Health, ticker CAH. Again, you can see the stock kept getting up to about 81.5 and took a big dive, got back up, down, got back up, and then we got close to it. It looked like it was tightening up. See, just 3 days where we had low volume, but it just fell. It fell right off, and we actually broke below this part of the base. So we still got on the watch list just because it was low volume, but this is starting to look not so good. If it goes much lower, it will knock it off the list. It's just not acting as it should. We don't want to see this breaking below. Definitely breaking below 73.08. The stock is gone off we're just not watching it anymore because it's not acting correct. Next one is Calix, CALX. Again, another one tightened up here. It looked pretty good, even though it's not really a buyable spot. And it came down. It got some support here on the 50. Got rid of some weak sellers. And then it kind of came right back up to that same thing. Tried to break out 2 days in a row and failed. Now, this is a real powerful stock because this stock just back in July was under $40, and we went up to almost $80. So we've had a 100% move. And that's something that something's going on there for a stock to make this kind of a move while the market's been so poor. Good relative strength, but we're starting to see the resistance now is the 50-day, the red line. It's had now 1, 2, 3, 4, 5, 7 days below it. Can't get above it. All in low volume. So we're still watching it, but it's not a great sign. We want to see now if it can come back up to around that 75 level, tighten up, and not show there's any more supply coming in because we're not getting the sellers pushing it back down and then break out. But it's a poor market. In a good market, this would have just broken out and gone. A lot of these, you can see how many times it tried to break out, can't get above, just sells off. So that's the market we're given for quite a long time now. Here's the next one, OI Glass. This one's actually looking pretty constructive too. We have a little cup with handle here, a pretty good RS rating, 95. A little warning here, we have our earnings and sales are starting to decline. Not great. I mean, they make glass containers, so it's a defensive name. But you can see we're kind of starting to tighten up here. We went from 17 down to 15 in a bit. A little lower, a little higher. We're starting to tighten up here. We'd really like to see it get more up towards the 17 and a quarter or so, and not have any more sellers pushing it down. And then we just break above there. So we're watching this one too. And then we have one more, STRA, which is Strategic Education. This one was actually looking pretty good, but Friday we didn't have a good close. Closed at its low, kind of broke below. Let's see, what was the low here? Let's see, that's the low, 78.03. No, it didn't quite get the new low, but if it breaks below that, now we've kind of breaking below this whole little short base. That won't be a good sign. We just have a couple here now on our long-term outperformer. First one is XL Service, EXLS. This one we're trying to buy around 172. When we go to a weekly, we're trying to buy this support off of this 20-week moving average, which is not really holding. So that's why we're still kind of watching it. Sometimes it pops up onto the buy list. It's been going back and forth because we're kind of getting above it, but we're starting to get a little more of a downtrend. You can see the 21-day is sort of acting as resistance. That's just what it is. Just it's not a good market. These stocks are just not going anywhere. But let me show you a monthly. Pretty good long-term chart, especially it's kind of more accelerating here over the last couple years. So that's good. The next one has a really excellent. This is a model book monthly chart for a long-term outperformer. Just a nice, long, consistent move up with not a lot of volatility. Obviously here, this is the 2007 to 9 financial crisis time, more volatility, but really just kind of tightened up and just kind of crept up. Here is, even in 2020, the big coronavirus crash didn't even get below this 21-month moving average. But now you can see that held for a long time, going back to 2009. We've broken it, and now we're hugging the 40-month moving average, which was where we're trying to buy it. But it's well, no, actually we're trying to buy it around the 21 month and above this this kind of base here. We're just not, it's kind of just meandering around, tried to break out, it couldn't hold. So that's it. Those are just not a lot of really strong contenders, but that's the market. Okay, so that's it. We're running about a half hour in this video. So we'll be back next week. We're going to just be looking for that change of character overall, which we'll be pointing out as we get it. But we're just not there yet, and but we'll be looking for that. And I can just say that at some point, probably I'd say towards the end of next year, well this year now it's 2023. I wouldn't be surprised to see a more sustained move up if the Fed gets to the point where at least they're pausing on interest rate hikes, and even maybe starting to talk about some rate cuts, which may or may not happen, but the market will start moving up probably as soon as they start pausing, because the market's always looking ahead. Okay, again, if you're interested, you can get a great deal on the Selling Stocks Mastery course. If not, no big deal, and we'll see you next week. Okay, thanks a lot.